All right, so today I wanted to talk more about a topic I've talked a lot about before, but I wanted to talk about again because there's still a lot of people that make this mistake. And the mistake that I'm talking about is thinking that dividend yield is the most important thing when it comes to dividend investing, right? And the reality of dividend investing is a lower dividend with a solid growth rate is a lot better than a high dividend with no growth. And I'm going to give examples of that just to kind of show my point. And I would preface this and say, I don't think every single company that pays a high dividend is a bad investment necessarily. And just because a company has a lower dividend and it's growing, it does not necessarily make it better. But I think on average, that certainly is the case. So I'm going to give some examples just to kind of show that, right? So a common example is QYLD. This is one of the covered call funds. Again, you have a current dividend yield of 15%. But again, this ETF has clearly outperformed the S&P over the last 10 years, even if we go to 5 years. Again, clear underperformance. Even if we go to 3 years, it's still underperforming, right? So again, has underperformed the market at every step of the way, even though, again, it has a dividend yield that's into the double digits, right? Another example, too, would be Ares Capital. This is I believe it's a BDC. Again, you have a 9.6% dividend that's actually growing a little bit, too, as well. Keep that in mind. But again, clearly underperforming the market. Doesn't matter what time frame you pick, it's still underperforming the market, right? Actually, if you go from 2020, but again, if we go, let's adjust it a little bit. So again, if we go for the last 3 years, technically it did, but if you go to 1 year, 2 year, it's still underperforming. But again, I would never look at anything less than 5 years to make a wholehearted judgment. So again, that's another example that again is very popular. If we look at another one, again, Ares Commercial Real Estate. This one's even worse, I believe. Again, 13% dividend. But again, I mean, if you go back 10 years, you have literally no growth, right? You have 14% over the last 10 years with dividends, right? So again, if you look at the mortgage REITs, I think the mortgage REITs are ones you want to avoid, like the plague right now. The BDCs, I still would be avoiding because I still have not came across one that outperforms the S&P over a 5-year or 10-year period. And until I see that, I wouldn't even consider touching them. The next one, again, is a stock, AT&T. This is one that I think a lot of people have gotten into because the share prices came down a lot, which, again, people think that makes it cheap. But, again, if we look at the performance here, number one, they cut the dividend, right, which is very concerning. But number two, again, you go back 10 years, this company has very, very little growth, right? Let's go back even 5 years. Again, there's no period where this company is even touching the S&P, right? So again, you want to avoid these companies, right? Just because they're cheap does not necessarily mean it's a good investment. Just because the share prices came down a lot doesn't mean it's a good investment. Just because the company's not going away does not make it a good investment, right? So that's something to keep in mind. Another one that's gotten absolutely destroyed that it's fairly popular is Annaly Management, NLY. Again, almost a 15% dividend, but again, over the last 10 years, the share, even with dividends, has gone nowhere, right? I mean, without dividends, it's gone down. So again, you want to keep an eye on these. Another one is PDI. This is kind of like a leveraged bond fund. So again, a little bit different. Again, you got a 15% dividend, but again, not even coming close to keeping up with the S&P, right? So again, another example of that I think you really need to keep an eye on. Main Street Capital is another one that's very popular. Again, also, you're not even, I think this one isn't as bad as some of the other ones, but again, you're still drastically underperforming the S&P, although you're getting better returns than basically all of the other ones. You're still clearly underperforming the S&P. Actually, if you go back about 3 years, it actually outperformed a little bit, so that's kind of interesting. That is kind of interesting. But again, you also have to keep in mind, like I said, for all of these companies, I want to see outperformance over 5 years, even 10 years, at least one, if not both of those, before I would be considering it, right? The next one is arguably the most popular one, JEPI. Again, if we look at that, again, this one's only been around for just over 3 years. It has done actually all right, 43% versus 59. If we go back about a year, it's actually about the same. Again, if we look back, it's not that much worse. But again, my preface for all of these companies would be at least 5 years of outperformance, and then preferably that 10-year mark as well, just to know that it's consistent, right? Because you want to know what these companies are going to do in a rate hiking cycle, rate cutting cycle, a cycle to where, mortgage rates are high, low. You want to see these companies in all of these different scenarios. We've seen the S&P in all of these scenarios, but we haven't seen a lot of these companies in all these scenarios. And this higher rate environment is something that's really showing the difference. Because again, if you go back, it's been what, 15 years since we've seen a hiking cycle, or a hike and cut kind of all together. So that's something that really needs to be kept in mind here. Again, so if you want to see my point here, let's just take the equal weight S&P index, right? This is an equal weight index that, if we look at the returns here, again, it's returned 191 versus 241 for the S&P. But again, if we go back 10 years, you have a 4.5% yield on cost. Let's go back 20 years, right? If we go back 20 years, you have a over 8% yield on cost, right? So again, this is a equal weight S&P index that's going to return 7 or 8% per year, that if you hold for 20 years, you're going to have a 8% yield on cost. So that just kind of proves my point in that, why would you buy these high dividend companies, or BDCs, mortgage REITs, covered call ETFs, you name it, when you get virtually no share price return? Some of them, they're actually getting negative return, when you can just buy an index like this and have that high dividend down the road, right? A lot of people say, oh, I want income, but it's like, most of the people that are saying that are very young. So it doesn't really make sense, right? I don't really see a lot of 70-year-olds saying, yeah, I'm gung-ho over QYLD. I barely ever see that, if ever, right? So again, let's just look at even the QQQs, right? The NASDAQ, right? It's not going to be as high, obviously, but I think it's still going to show. So again, if you go back 10 years, you have a, 3.2% yield on cost. If we go back 20 years, you have a 6.7% yield on cost, right? So again, even the NASDAQ, right, which returns more than the S&P over the long run, still you got a 6.7% yield on cost 20 years ago, right? So that just proves my point again. Why are you buying these high dividend companies when you can get that high dividend accumulated with the growth over the long run? Now again, obviously you're going to be buying shares over that period of time, so your yield on cost is not going to be 6, 7, 8%. But even, let's say, 30, 40 years from now, there's no reason you couldn't have a 5% yield on cost, right? So again, why would you be worried about income when you can get that income when it comes to the higher dividend and selling covered calls? This is another strategy that people don't use for whatever reason. You want to be selling covered calls and rolling them monthly, because that's going to generate an extra 2, 3, 4, 5%, right? So if you can have a 5% yield on cost and you can generate 3, 4, 5% more per year, that's a 7, 8, 9, 10% yield right there, with less risk than a lot of these companies, right? If you want some examples of some stocks, probably maybe my favorite one, Alimentation Couche-Tard. Again, if we look at this company, again, clearly outperformed the S&P. If you go back 10 years, you have a 6% yield on cost. If you go back 20 years, you have a 29% yield on cost, right? Just insane, right? Let's take another example, right? CN, Canadian National Railway. again, going back 10 years, you have actually only about a 4.8% yield. But if you go back 20 years, you have a 22% yield on cost, right? So again, just another example, right? Let's give another example here. Waste management, right? So again, you have a going back 10 years, you got about a 7% yield, over 7, right? And you go back 20 years, you have a 11% yield on cost roughly, right? So again, one more example that I would give, Visa. Again, I don't know if Visa is going to be a great hold long term, but I think that this has been an absolute no-brainer over the last 10 years or so, right? Again, only has a 0.8% dividend, right? But they're growing at 16% per year, right? 10 years ten years ago, 5%. This company's actually only been paying a dividend since 2008, right? So, but I mean, if we look at when they first started paying it, you'd have a 12% yield on cost, right? So again, that just proves my point in that if you want to have it summed up easiest, I would be buying companies that have room to grow. Their payout ratio isn't too high. Again, if you look at this payout ratio, 22, 23%, and again, they're growing at 16% per year. I want companies that are growing their dividends 10, 15, 20% per year that have room to grow and are still growing very nicely, right? I mean, and if you want to know, it's very easy to figure out, right? Let's just show it with Visa here. Go into the freeform tool here and go back, roughly 10 years. Again, they're growing their free cash flow per share 13.48% per year. Operating cash flow is growing by 13.3% per year, right? I want that growing at least, let's say, 6-7% per year, because you want companies to be growing more than inflation or even the 10-year bond, right? So you want more, at least 5-6%. That's my absolute bare minimum. You also want to keep an eye on the share price, right? Because if a lot of that growth is simply coming from people paying more for existing levels of cash flow, then that's just making it more risky. So that's another thing to keep in mind as well that I mentioned before. So anyway, I just wanted to make a video about this because I think that, again, there's a lot of people, especially new investors, that fall for this mistake. Don't fall for this mistake because it's an easy one to make and it will cost you in the long run. So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe and stay tuned for more.